On today's program, thinking of Amazon, Netflix, etc., seems to represent a new business model that says, yeah, we lose money on every transaction, but we make it up on volume. Is that sustainable? And when does actual profitability and personal relationship matter?
The McAlvany Weekly Commentary, covering monetary, economic, and geopolitical news events.
In every generation, you have a choice to pull yourself up by your own bootstraps. It doesn't matter what you inherited from the previous generation, physical, tangible assets, or complete social and emotional emptiness and bankruptcy, because those kinds of things can be translated from one generation to the next. But the question is, what will you do with what you receive? You may not like it, and frankly, it's up to you to change it.
Now here are Kevin Orrick and David McAlvany.
Welcome to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany. David, you're traveling all the time. In fact, you're in your travel clothes. You literally stepped off the plane this morning before we recorded, and you're just about to get back on the plane for these conferences that you and your dad are planning on doing. I think before we get into the commentary, we ought to review the dates and the places that you guys are going to be.
Yeah, we're going to be in California. That's where our Whistle Stop tour begins. And the first date is always when we're having our meetings.
Right.
And the second date is when we're actually doing private consultations. So July 14th and 15th, we're in Palo Alto, California. July 19th and 20th, we're in Agoura Hills, California. And then we're heading north to Bellevue, Washington, July 25th and 26th. Portland, Oregon. We'll be there July 28th and 29th, and then Scottsdale, Arizona, August 1st and 2nd. And then we end this little segment of the tour August 8th and 9th in Denver, where we started our company in 1972.
Yeah, and we would just ask anyone who would like to come to the conference or have the private consultation the next day, please give us a call at 800-525-9556, and you can ask for extension 118. Karis will put you down as an RSVP. Dave, we just came through Father's Day, and something really hit me. I was with my son, both my kids are millennials, and we were just eating the other day, and I made an offhand comment, and I felt bad about it because just offhand I made a comment about the millennial generation. My son paused for a moment and thought, and then he said, you're right. Yeah, the millennials this, the millennials that. He was talking about some of the deficiencies that we see in the millennial generation, but it really ruminated with me, Dave. My generation was no better than the millennial generation. In fact, my generation is up to their eyeballs in debt. Our parents' generation, even though maybe they would be called the greatest generation, not all of them were great.
Well, the reality is, in any generation, you have great strengths and great weaknesses.
Yeah.
And we tend to kind of focus on one aspect, whether it is over-fixation on the weaknesses of a generation or over-fixation on the strengths of the generation. And we're people. That means we're messy. That means that there's a lot more to the story.
Well, in millennials, I have to give it to them. They're not as materialistic as my generation. They don't feel that they need the 3,000 square foot house. I was just talking to somebody who's downsizing to a 38-foot trailer, and they have a family of 4. But you know what? They're excited. It's an adventure to them. And being millennials, to them, they want to own what they own.
Who says we need stuff is kind of one of the operating questions. I'm interested in revisiting a conversation we have had twice with Neil Howe.
Yes.
And if you recall, a book that we've discussed in the office, read as an office read, was The Fourth Turning. And it looks at 600 years of British and American history and the changes that occur about every 100 years. It subdivides those 100-year periods into generations.
Yes.
And he looks at how these generations interact and what we learn, what we fail to learn from one generation to the next, and what the social and political ramifications are. He also has sort of an economic and financial overlay to that. And, later this month, I'd love to invite Neil back onto the program and kind of look at where are we at in this sort of seasonal change, if you will, in a 100-year period. Where are we at and what can we anticipate next? Because, what you're talking about, generational change, absolutely critical to understand.
Well, and I'm hoping that this generation that's coming in after us will value relationship. We've moved to sort of an internet age where Amazon is providing everything and there's a disconnect between people. But I'm also noticing that the millennials and the generations after them are starting to crave relationship. Father's Day is a good example. When people are thinking of their fathers, they get together. Most people, hopefully, who are listening to this program, had a good Father's Day.
I'm grateful. I'm grateful for relationships. Celebrating Father's Day for us was up at the lake, and we had barbecue, and I think the kids loved finishing with a movie and ice cream. And I think along with just about every father, there is sort of the value of family, the priority of time spent, the imperative to deliver on your commitments to your kids. Kids are interesting. They don't have written contracts with their parents. At least I don't know anybody that does.
Right.
But when commitments are not kept, there is the equivalent of sort of breaking of a contract. And so it's an unspoken social contract. The opportunity that we have, Kevin, is to cultivate a respect for commitment and loyalty and relational connectedness. And that's a daily opportunity. Mm-hmm. When I speak of managing intangible resources, that's sort of in a parallel track with what we do for a living, managing tangible or financial resources. This is kind of what comes to mind, the family stuff.
Well, and, I was thinking about this today, Dave. We tell people, well, we have a podcast radio program, but you know what? Everybody has a podcast radio program these days. And we tell people that we deliver news, that we try to filter through and give good information. Everybody's doing that, and they're calling it fake news. You just have all this spam this, spam that coming into the internet. But actually, agreements in the long run break down unless there's truth in the arrangement. Now, we have agreements not just with our clients. We have agreements with institutions, some of the largest brokerage firms in the country, that we have to maintain. We can't be giving them fake news. We can't be variable in our relationship with them.
Well, you're right. This is the 10th year of our weekly commentary. We've been doing this every week. Can you believe that?
Right.
For 10 years. And I was out in the Midwest this week visiting one of our institutional clients.
It's a very large institutional client.
The original agreement that we made with them goes back 33 years. Mm-hmm. And as you might guess, it came off of an old school word processor. It's the kind of the electric typewriter style that you had in the 70s, 80s, even into the early 90s. And, the agreement was simple. It was short, and it remains the same today. There was no need for a legal dictionary, and there was no attorney to draft it, and it's still in effect.
Yeah.
And I look back and I think times change, and sometimes time changes people and organizations, but for us, the better part of wisdom is to always value and elevate relationships above whatever else may have shifted in the interim.
Well, and what's interesting to me, 30 years ago, when I first started here, I was talking to people from this particular institution. We won't name it. Most of those guys have gone on to retire, and there's new guys that have come in to replace them. Yet our relationship and the agreement still stands.
Yeah. I mean, we've done what we've said we do for 33 years. They've done what they said they do for 33 years. There's never been a complaint either way. Now we're in our fourth decade, and the markets continue their shifting. We have regulatory requirements which continue to morph and match, because there is sort of a market evolution.
Right. But the relationship doesn't change.
Yeah, there are relationships which do, I think, stand the test of time. So honestly, there's very little that offers greater intrinsic reward than to carry forward a business relationship that began when I was in grade school.
Right.
And today to keep it in healthy repair. In an agreement, there is honor, there's obligation, there's intention to do right for both parties. And
these weren't agreements that you put together. This is an inheritance from another generation.
That's right. What I have is an agreement that I need to honor and in the daily activities of our business. And I'm reminded that in a family-run firm, there's greater latitude to live and operate with something equal in value or even greater in value than profit. Now, mind you, if you neglect profitability, you do seal the fate of an enterprise. But having a venue where intangibles can be prioritized, that is incredibly rewarding.
Well, and we're living in a day where relationships and agreements are as simple as a click of a mouse and as easy to break as just returning the product. There's very little relationship in some of this new market that we're starting to see. But when you start talking to people who are having to deal with larger projects, okay, you just got back from a trip where you had spent some time talking to a man who's head of a very large project, relationship and agreement is of utmost importance.
I think one of the striking things that he said to me, and I was on my way to the Midwest, and I had this intriguing conversation with the gentleman you're speaking of. And I mean, he was long on common sense. He was worldly wise, and that came from decades of operating in a highly competitive business environment. He was born and raised on a ranch, and his perspective on the world came from, as you mentioned, the various leadership roles he's had in international companies. And he said this to me. He said, "It took me over 50 years to learn this, that there's more to life than money." And he described many of the conversations that he has with friends and colleagues where they haven't learned that lesson yet. And they're still in pursuit of the next, the greatest, sort of the infinite goal, where the goalpost that he had, the infinite aspiration, the desire for more wealth that really is an appetite that can never be satisfied. And he just flat out said, "It took me 50 years to learn that there's more to life than money."
Well, and we were talking about generations. Money to us is debt. So we should rephrase that. There's more to life than just debt. And the more debt we pile on, in a way, we feel like we can't feel it. You know, I've talked to clients and they've said, you guys have talked about having to pay the piper on our debt for decades, yet I don't really feel it, but the effect is still there. I mean, it's sucking away from the growth or the capital accumulation that could have occurred had we not been paying debt payments.
His observations, I think, were helpful. They were hopeful. One, that, Trump might actually bring something other than the same old sort of motionless political quagmire, but they were also very realistically limiting. And his comments reminded me of a Financial Times article I read this week. The Financial Times article was on inflation, and it was, suggesting that we're still struggling to raise the level of inflation to that which central banks consider acceptable. Evans this week from Chicago, that's Fed President Evans, has basically said, look, we're not there yet. Our goal is 2%. We still need to get that. We're missing on one of our serious policy objectives, and they're still trying to drive that rate of inflation higher. So the central bank community is struggling to resurrect inflation, and you've got the burden of debt, at least according to this Financial Times article, which remains an obstacle. So you get too much debt, and you get the resources in the financial system, which would ordinarily be recycled through the economy over and over again. And what's happening is those resources are being siphoned off to pay claims to the creditor class.
Well, and I would have to take exception, Dave. We don't need inflation. We don't need 2% inflation. We don't need 1. We don't need 5. That's not growth. To a central banker, that may be growth, but what he is pointing out is they can't restart the economy. That's just another way of saying we have not been able to restart the economy. Why? Because they've built debt on debt on debt on debt. And we all know from our personal life, Dave, you get into too much debt, and instead of it giving, like the encyclopedia salesman who says, look, if all you do is give up a Coke a day, you can own this encyclopedia. The problem is we don't have 50 or 60 or 80 Cokes a day to give up.
The big theme from that Financial Times article was the siphoning off of wealth. Mm-hmm. That's maybe the words that I would use to describe it, but it echoed this rancher's opinion that there is different versions of siphoning off wealth, and it's why the system is broken. And he would point to actual corruption in the political system here in the United States, but also, and I was reminded of this going back to Richard Duncan's book, The Corruption of Capitalism,
right,
where he basically outlines this morphing of capitalism as we knew it, free market capitalism 100 years ago, to what he describes today as debtism, which is a complete replacement of what we knew as capitalism.
Well, and Dave, we would have velocity in money right now if we had any growth whatsoever. Remember Milton Friedman, he just assumed that velocity, or the turnover of $1 every year, would be at least 1.7. But that's turned out to not be the case. As we've gone further and further into debt, the velocity has fallen through the floor.
Well, but that's exactly right. And recall that velocity is simply the number of times a dollar circulates through the economy. Mm-hmm. And Friedman was wrong. Velocity is not a constant. It is variable. And you're right. Velocity has collapsed over the last 12 to 15 years. And a robust economy generally sees higher velocity.
That means people are spending money and accumulating money.
That's right. And those dollars, when they're put into the banking system, get relent and respent and relent and respent over and over and over again. So again, there's this idea that a robust economy generally sees higher velocity. And with higher velocity, you also tend to see higher rates of inflation. Now, there is a threshold moment where velocity can go absolutely bonkers, and it quits telling you about the health and heartbeat of the economy.
That's when
it
people
starts
are
to
rushing.
tell you about panic because people want out of the currency, and all of a sudden you see a massive uptick in velocity where it actually is a repudiation of the value of that currency. Now, I'm not talking about that. I'm talking about, just a low level of inflation.
Right.
And the era of low inflation that we've had, say, since 2008 and 2009 has coincided with incredibly low levels of monetary turnover. There are multiple reasons for this. As I just mentioned, as debt levels have risen, a greater percentage of capital is required for debt service, right? That leaves less to circulate for consumer spending, less to circulate and become savings, which would be sort of future capital for investments, right? So financial institutions have essentially siphoned off resources that would otherwise circulate in the economy.
Well, let me just throw this out, though, because this is the mindset that we have, and that is, well, who cares about velocity? We'll just print more money. We'll just create more money out of thin air. If it's not turning over in the hands of the people, we'll just flood the market with, well, helicopter cash. Remember Ben Bernanke?
Okay, so this is one of the key distinctions that Duncan makes in his book, The Corruption of Capitalism, where he basically says we've changed the definition of money from fiat that you print on an actual printing press to something that we can do digitally now and do infinitely. Just ones and zeros. We can create credit out of nothing. Now, the difference between creating credit and creating these, what we know as Federal Reserve notes or dollars, is that credit has two sides to the equation. There is a debtor and a creditor. So you might argue this point and say that essentially creation of credit is like creating money out of nothing. It is creating new money, our modern day money, out of nothing. But here's what it requires. It requires that the limited amount of income, whether it's household income or corporate income, that is corporate profit, that is government income via, if you want to call it tax heist, we're talking about tax revenue, more and more of that income in any form has to be utilized for debt service.
Right.
So yes, there is additional capital created when we create debt, but that doesn't necessarily translate into an increased means of paying for the obligatory portion of that capital, and that is the interest component.
Well, we've been to Detroit multiple times. I haven't been to Puerto Rico, but I know you have. Those are two examples of when the debt gets to be too much. If you've been to Detroit recently, I'm sorry for the people who are listening, but yeah, it's changed.
You're right. So Detroit a few years back, Puerto Rico just a few months ago, and we're witnessing across the state of Illinois at present where, frankly, it's a slow motion train wreck. It's occurring right now.
Are you thinking they're going to go bankrupt as well?
Anything is possible. As of last week, they have $14.7 billion in a backlog of bills to be paid. That is owed by the state to private individuals.
Now, they can't print their own like the Federal Reserve can do it for the national debt.
That was the same problem in Detroit. That was the same problem in Puerto Rico. Yeah. It's illegal to run your own printing press, right? So you've got population flight in Illinois. You've got a business exodus, which is exaggerating this trend, again, reducing the income that the state needs to pay for its bills, and they're not reducing the number of bills. Mm-hmm. That's guaranteeing the next round of extreme measures by the state and local authorities. What does that look like? I don't know. Maybe it's an increase in tax revenue via real estate taxes. Maybe it's an increase in sales taxes. Is Illinois the first state to introduce a VAT? The reality is there's too many obligations and not enough income to keep up with them.
Well, let me talk about a phenomenon that this causes, though, Dave, because not everybody loses when there's a lot of debt. Okay, let's use an example right now, because we're seeing brick and mortar stores close. It's an amazing phenomenon to live through over the last couple of years, where the Amazons of the world are just replacing the mom and pop stores. Now, that's not all bad if it's competition, but these large organizations that are running, they're losing money on every transaction, but they don't need to make money. How does a mom and pop store compete against an Amazon who knows that the money is going to keep flowing from two directions? One is unlimited amounts of debt if they need it. The second is all of these indexed funds and the funds that are focusing on these FANG stocks going in and just buying stock. And so it raises the capitalization of the company. What if, Dave, I'm going to throw this out. What if the business that you ran here, the company that we work for, really didn't have to make money as long as you could get more debt and get the stock price continuing to rise?
Right, and then use the stock as it rises as a form of cash.
It's like the financialization of the economy.
That started to happen in the 1990s
and
arguably the late 80s, but really began to catch fire after Glass-Steagall was done away with in 1999.
So it concentrates the wealth in a very small region of owners of companies, and that's it.
It's no accident that you had an explosion of growth in the derivatives market and massive leveraging within the financial system, but specifically your banks and financial entities up through about 2007, 2008. Of course, that came unglued, but very interestingly, we've seen that same leveraging up within corporate America. So this idea of financialization of the economy, we're talking about a shift from making stuff to making money on the stuff that people theoretically sell or buy or what have you. And we mentioned this a few weeks ago, where retail businesses are making a huge percentage of their profit from financing, that is the credit cards that they offer. Take Macy's as an example. They make a huge amount of money off of the Macy's credit card, not just the merchandise they're selling. I mean, we're talking 30 to 50%, depending on the quarter. That's a massive contribution. And so what is Macy's? Are they a retailer or are they some version of a bank or financial entity?
Well, and there's a balance there, Dave. They don't want the debt paid off. This is how they're actually making money. They don't want you out of debt. They want you in debt just enough to where you can make your monthly payments.
But this is the concept of siphoning off resources that would have otherwise gone towards more productive things. As the financialization of the economy has occurred, there's been an increased amount of debt, but not a proportional increase in incomes for individuals needed to pay for that debt. So here's a couple of other ways that assets have been siphoned off from various economies. And I got to thinking about this after the conversation with this gentleman on the plane, because it really is an interesting phenomenon, and it's happening at the macro level and at the micro level as well, where resources are being siphoned off. And it's no surprise that the Fed's having a hard time increasing inflation and that velocity is absolutely on its keystroke.
Well, strangely, we've talked about what you look at on the dashboard to see what's going on. Strangely, velocity is the thing that's showing us.
Well, right. So think about the myriad ways in which velocity drops at both the macroeconomic and microeconomic levels. Amazon. Start with Amazon. They siphon off money from local communities by taking dollars that would otherwise be spent in a local economy and recirculated in that local economy. And instead, it reallocates those dollars to a corporate nexus in some other part of the country. So we're talking about the death of mom and pop proprietorships. And I think it's very unhealthy. It's very unhealthy for small towns. It's very unhealthy for dynamics within a community. And it reminds me, I know you've experienced this. You drive through places all across the country, and they had their heyday decades before. Could have been from an oil boom, an industrial boom, some sort of agricultural boom. But the dollars were there, and then the dollars quit flowing locally.
Dave, they become ghost towns. I remember growing up, there's a town in the panhandle of Texas that I grew up going to every summer, my brother and I. And we would spend the whole summer, just in cut-off shorts, and we'd never put shoes on. It was a wonderful town. But there was two highways. There was a north-south highway and an east-west highway that ran right through town. And I remember my grandmother telling me the story. She said, Kevin, they're building something called Interstate 40, and it's going to bypass the town. So it's a horrible thing to think about when you're a little kid, but she said, someday this town won't be what it is today. And it's true. The town has turned into a literal ghost town. There's just a little over 1,000 people living there now. I'm not saying the interstate was a bad thing, but the effects of an Amazon nationally reminds me of the effect of the interstate on the small town on Route 66 that used to be booming and is no longer booming.
Well, what you're talking about is technological rechanneling. In the case of this town of the Panhandle, it was a flow of traffic, right? But what we're talking about is a flow of dollars, and either way, you create a technological bypass, or you create, an actual I-40 bypass,
right?
And it has the same effect, which is that dollars quit flowing locally. The economy shrinks to the point of forcing people to relocate, and this is why, again, you can go across the country and you see empty cinemas.
Right.
Empty cinemas all over the country. And it's a reminder that at one time there was enough people and money flowing in that place to sustain a small town movie hall. But that time has passed.
So is Amazon the next interstate?
I think Amazon represents a 21st century threat to small town businesses. And it represents the monopolization of retail. And I agree that the internet opens the door for small enterprise to move in, to relocate to more desirable communities. But old school brick and mortar businesses are being hollowed out by companies like Amazon. The main point being, when the money leaves a local economy, this is not a rant on Amazon. This is looking at cause and effect.
Right.
When money leaves a local economy, small town velocity falls. And so the burden of debt for those small towns grows disproportionately compared to the incomes that still remain. What does that do? That leaves authorities to either voluntarily shrink the scope and scale of local government. Good luck with that. Never seen it happen before. And what they usually do is just slowly bleed a community dry because they'd rather choose willful blindness to sort of a financial crisis as it's sort of unrolling in front of them.
Well, and again, some of this is just the nature of creative destruction, what we've talked about, and creating competition. But competition, when it's unfairly siphoned one direction, we were talking about Amazon, they don't need to make a profit. Tesla doesn't need to make a profit. Netflix is losing over $100 a customer. They're not needing to make a profit because of the stock market and because of their ability to take in debt. So there is no way to compete when one of the companies that you're competing with doesn't have to profit.
Well, it's interesting because it's as if markets are driven by capital, and that in some ways redefines what we understand as free in that equation of free markets. Because it really is who controls the capital, who has access to the cheapest capital, and how can you monetize your share price to be able to grow a business. And to be honest with you, if you operate in the private markets as opposed to the public markets, you have limitations in terms of your access to capital. So I look at national firms, and this would be another example of sort of a siphoning off of resources from local firms, where scale matters and where if you're looking at cost structures, for a larger firm, you can deal with certain efficiencies because of an economy of scale. And there's a little bit of twist of irony. Here in Durango, we have a local bridge, what we all know locally as the Bridge to Nowhere, which was built under one of the Obama-era economic recovery spending sprees.
Huge, millions of dollars. It looks like the mousetrap in Denver.
The construction company that built it was not from Durango.
Yeah.
And not a single Durango local was hired to rebuild this $10 million bridge. I know because I spoke to somebody who was consultant on the project, and there was not a single Durango person building the bridge. So other than the temporary influx of hotels and meals from workers that were brought in from Denver and other large cities, the income, the wealth was siphoned off and ultimately circulated elsewhere, right? So there was an appearance of economic activity, but it had no lasting boost to our little town economy, as most of the $10 million went into houses, retirement accounts, long-term savings, paying bills elsewhere in another part of the state, in another part of the country. This is my point again. Velocity is the number of times a dollar circulates through an economy. Small town velocity is just as important as state or national velocity, and these are the kinds of things that explain why we're seeing such a limp economic recovery.
Well, let me then ask about the global, because you've talked about small economies, you've talked about national companies siphoning from the locals, but we have a global situation too, where a lot of the workers that are here in America right now, Dave, are brought in. Go to Seattle. Try to find somebody who's not from India in the tech business.
And again, this goes back to the conversation I had with the gentleman on the plane as I headed to the Midwest. And when I described his comments earlier as realistically limiting, this is really where the conversation went. Because we're all thinking that Trump is going to spend whatever he's going to spend, $1 trillion, $2 trillion, $5 trillion. Who knows if he has 4 or 8 years, how many trillions of dollars he'll spend to improve U.S. infrastructure. But here's the reality, and this was the point of our conversation on the plane. Global firms siphon off cash from domestic ones. And I'm not trying to sound protectionist here. This is just a simple observation that in a market economy, businesses seek opportunity anywhere they can. And if there's going to be U.S. dollars spent, everybody's going to throw their hat in the ring. In 2010, when infrastructure spending was grinding to a halt in Europe, now keep in mind the decade preceding that, probably the two and a half decades preceding that, where infrastructure was being built in Europe and bringing it to a level that's probably 10 times better than that of what we have in the United States. And I say that from firsthand experience. I've spent a lot of time in Europe. Well, guess what? That infrastructure spending ground to a halt just prior to the pinnacle of the crisis in 2011. So 2010, infrastructure spending stops, and those European firms had to start seeking revenue in fresh geographies. Guess where they landed?
Right.
Texas tollways, California high-speed rails, just about any other major infrastructure project is an attractive revenue target, and they're here.
Yeah, but isn't there hope that Trump is going to try to go American or go United States when he's doing these infrastructure projects?
Right. Well, again, I mean, I'm not doubting that there's going to be money spent on the infrastructure projects. What I'm talking about is the siphoning off of cash and it not being recirculated here in the United States. The real impact of spending $1 trillion is if it recirculates in the economy once, twice, 3 times, 5 times over a year, where it's aggressively saved, spent, saved, spent, saved, spent. Again, this is the nature of a fractional reserve banking system. I'm not here to comment on the validity of a banking system like that, but just to say you can deposit funds, it's relent, spent, and that's what gives you a bigger economic footprint from the dollars that go in when a government spends like that.
Well, just a reminder to the listener, this is not a political talk because you are sounding protectionist, Dave, and you're not trying to. You're saying, look, we have to observe this objectively so that we know how to react to the changing system.
If Trump and his administration were able to stir economic activity by placing a few $1 trillion into the U.S. economy for it to then roll around and recirculate, leaving a very impressive footprint, a considerable increase in GDP growth, that would be great.
So do you think that can happen?
The fact is today it can't happen. At least it won't happen as desired. It can't happen because civil engineering and contracting firms, the ones that have the capital to bid on multi-billion-dollar deals, this is where the rubber meets the road. These companies not only handle the design and construction phases and carry them from start to finish, but often provide maintenance via service contracts, which are maintained over long periods of time. The reality is we have 4 main U.S. firms that have the capability of doing this. There are 25 European firms that do and are already here and are bidding on the contracts and winning them. The sad reality is that as we begin to spend on U.S. infrastructure, there will be a massive flow of dollars to Spain, to Italy, and to other European countries that have access to, let's go back to this whole idea of corruption of capitalism and how credit plays such a role. When you lower the cost of capital to nothing, guess what happens? You've got companies that have cozied up to the state, and they now have access basically to free credit for financing. Financing what? Oh, financing the deals that we're talking about here in the U.S. So again, instead of dollars being spent in the U.S., recycled in the U.S.,
it's the European Central Bank that's financing it.
And again, the nature, the dynamic of these deals is fascinating. These companies will often bid a job and take a loss on it, so long as they add to current revenue.
All right. Now, I want you to explain something, Dave, because I think a lot of people don't know the difference between current revenue and profits. Now, you have to profit to stay in business long term. You are seeking current revenue if you're actually in trouble, right? I mean, usually if you're just seeking current revenue and you're doing that at a loss, that's only going to last so long.
Well, you don't necessarily have to be in trouble. I mean, it can be a business model that says, hey, we're growing our revenue, and as we grow our revenue, we are rewarded by an increase in share price, and we translate that increase in share price by going out and buying a new business, and buying that new business adds to revenue. That increases our share price. And it's a bit of a pyramid scheme. The way you work a pyramid scheme is it builds and builds and builds, and then it collapses instantly.
Have you ever had work done on your house by a guy who's 3 houses behind in paying for what's happened? I have. That's a horrible thing. That's chasing revenue when you're not profiting.
That's when economics finally catches up with you. But what I'm saying is there is this deep subsidy in the marketplace today, which is free capital, right? And it's allowing for a massive distortion, a massive ignoring of risk. And we're talking about balance sheet risk for these companies. We're talking about a means of growth that ultimately is not sustainable. So they win contracts, being the most affordable, and then often turn the costs of the project into long-term interest streams. So, for instance, let's say I want to bid, and I know the cost of a project is $2 billion. The cost. And I bid at 1.8.
Right.
The local authority says, well, let's do 1.8. That makes sense. They're going to deliver under what our budget was, and I think the costs are going to be about 8. That's great. But then they turn around, the company turns around and finances the deal, says, look, you don't even have to spend the $1.8 billion. We'll finance it for you. And we'll finance it over a 50, 70-year period. And so now all of a sudden, the state's like, hey, this is great. It's not going to cost us any money out of pocket.
They're not just building a bridge. They're giving you the loan to do it.
Right. Of course, when you structure those kinds of financial deals, you're often doubling or tripling the final cost of the project. And this is the danger of interest. We know this from a home purchase. I remember when I was 16 years old, and I watched the folks who were buying my parents' house in Parker, Colorado. And we're there for the loan doc signing, and there's all the disclosures and everything else, and here's what you pay for the house. And here's what you pay at the end of 30 years with interest. And it was more than double the price. And they looked at each other and they were like, how's this possible? That's not what we agreed to pay for the house. But what they hadn't thought of was the cost when you include interest over time. So you've got these companies that, again, they're willing to take the loss up front. They have big enough balance sheets and big enough financial backers in Europe to be able to do this.
Well, then let's just bring this home to the point. I mean, the point is we're really counting on several $1 trillion being spent in our economy because of Trump, but we don't even know that those dollars are going to be in the economy.
And that's the point again, because we're talking about a siphoning off of resources at a micro level, the siphoning off of resources at a macro level. And so, yeah, the main point is that resources that are likely to be spent by the Trump administration, they're not going to remain in the U.S. They're not going to recirculate through our economy. The end result will be far less substantial than anticipated because of the siphoning off of resources. This, I think, is one of the things that contributes to the trend in lowering GDP growth expectations. So last week we had the New York Fed lower their second quarter GDP numbers from 2.3% down to 1.9%. As we mentioned a few weeks ago, GDP statistics have been stagnant. They have been way below a natural and normal level, certainly below a level that you would consider to be healthy and robust for economic growth and recovery. And they've been there for over a decade.
So the model, Dave, let's talk about the model. The model of running a business where you're chasing revenue growth and you're doing it with debt.
And you're ignoring profit and loss.
And you're ignoring profit and loss. Now, this is a model that the government has given us for many years. All right, we were talking about generations. I can tell you my generation, the last 40, 50 years, has left the millennial generation with a whole lot of debt and very, very low growth, low GDP.
Well, the model of growth so popular among European civil engineering and construction firms today, it borrows from a playbook that we saw with Tyco and with General Electric, a playbook which in past periods provided hyper growth for companies and depended on sort of constant acquisition and accumulation of revenue streams. So management of the acquired firms was less critical. Again, you could mismanage the business, but there was this upfront financial improvement which marked an immediate increase in revenue for the year, in the year of that acquisition. And Wall Street was just happy as a clam to do that. So, GE ends up managing a debt book of $500 billion. And they end up being more a financial institution than, this is again, the financialization that we were talking about earlier. GE by 2007 was as much a bank as they were a manufacturing giant.
Well, and there's something different about this, though, Dave. It requires forward momentum, and it requires more and more forward momentum. It reminds me of the scene in Top Gun when the two jets are fighting each other, and the one flies through the jet stream of the other, and it shuts the engine down. Why? Because there was no airflow coming into that jet engine. It's really hard to restart anything that requires that much momentum.
You're right. I mean, debt is often the tool used to make acquisitions. It's what gives the artificial airflow. So, yes, there is a significant increase in long-term balance sheet instability. But everyone today seems to be comfortable with leveraging up.
Yeah.
And now it's not just sort of the pre-2007 banks and financials anymore. You've got corporate leverage, which has never been higher.
So we're at all-time highs on corporate leverage right now.
Yeah, and not that this is a tangent, but I think it's worth noting that if you go back to the 1990s levels of corporate leverage, which at 25% lower than they currently are, right? So we've increased our leverage. If you just went back to where we were before, take off 25% of what we have today, leverage in the corporate sector.
What would that do to profits?
Your profit margins would drop by 80%. Wow. 80%. So yes, corporate America has fallen in love with what brought us amazing bank profitability prior to 2008 and 2009. But this is the point. Greece did this. Cyprus did this. Corporations in those geographies that use this model of growth, they hit a brick wall when finance capital was no longer available on reasonable terms. It was like not getting air into your engine. What happens? Oh, the engine shut down. What happens next? The aerodynamics of a jet become really interesting when you have nothing to propel them.
Do you remember back in the 1990s, the late 1990s, when we had the tech stock boom? I read article after article, you probably did too, because you were in the brokerage industry at that time, about how companies no longer needed profit. Profit was just sort of the PE ratio was something that was completely ignored by companies, because what they were really doing was they were thinking ahead and working towards the future. You know, Tesla, Elon Musk uses this same kind of mentality, but it's unsustainable. Those companies back from the late 1990s that were telling us that they didn't need profit, they don't exist anymore, Dave.
Yeah, so returning to that, the unsustainable aspects of this model are when you ignore profit and loss with a preference for focusing on revenue growth. Of course, the grease in the gears for this kind of growth by acquisition model is low rates. That's right, low capital rates, low borrowing rates. And that is the basis of financing deals.
That's critical.
What does this recall? It recalls Tomas Sedlacek's warning that you have sort of this cult membership in a false religion of perpetual growth. There are limits, and it's easier to recognize what the limits of growth are, what the limits are of leveraging up and of borrowing to grow. It's easier to recognize them in retrospect than by anticipation. You know the limit when you reach it. You know the limit when you're in free fall. You know the limit when it's game over. And quite frankly, we don't know how far is too far in terms of corporate leveraging. We just know that we're now farther than we've ever gone before in terms of corporate leveraging, and it's beginning to reflect the same kind of risk-taking that the corporate level financial management is taking on, the same kind of risk dynamics that you saw with Lehman, with Bear Stearns, with AIG, where there's risks that are being taken, and everyone assumes that it's going to continue working, and it does until it doesn't.
So let's reflect on last week's promise from the Federal Reserve, because you said low rates are critical to this. Okay, now they've already told us that they're going to have 4 rate increases in the United States by the end of next year. How long can they raise rates where this formula still works?
I think that's the question that has to be asked. So 4 rate increases in the U.S. by the end of next year. The promise to reduce central bank balance sheet assets, which means they're selling off and allowing certain debts to mature, not repurchasing to allow a natural flow off of their balance sheet.
Well, and the ECB is talking about tightening as well.
And it's not a promise, but they are suggesting it. So when you look at a tightening of global monetary policy, is it possible that corporate culture learned something, but learned the wrong lessons from the global financial crisis? Is it possible that they learned that reward can be pocketed? That financial crisis, when it comes, is not a concern because risk can be socialized across a broad class, not of shareholders, but ultimately of taxpayers. Because it sure looks like the way they are leveraging up, that's what they took away from the global financial crisis.
You know, not one of those banking executives that caused the financial crisis back in 2008, not one went to jail or was prosecuted. This is an amazing thing, Dave. I mean, that was brought out at the end of the movie The Big Short. You got to see the criminal activity, but really what they're basically saying, and this is the mindset today, is operating without regard for tomorrow. Yeah, we talked about generations. That's what we've done, but tomorrow is the next generation.
And it seems to me, Kevin, that there is this possibility that perhaps they weren't breaking the law, but that we changed the laws such that we moved into a crazy world that allowed them to do crazy things without any consequence for that craziness.
And you're just saying that they're probably thinking the same thing today.
Right. I mean, Glass-Steagall was eliminated, and all of a sudden we opened Pandora's box for the financialization of the whole world and whole universe. Is it possible that that one thing changed our economy forever? Now, I don't think so. Because again, when you're matching up liabilities and the income that it takes to keep payments current on those liabilities, there are natural limits.
Okay, but sustainable economic activity takes a back seat to leveraged growth when you have that mindset.
Yeah, so it seems to me that the mindset today is sort of operating without regard for tomorrow. And you're right. If you're going to have sustainable economic activity, you've got to look and say, how much leverage should we have in the system? Is there any way that we should sort of put a governor on that? Or are we just going to operate without regard for generational or future consequences? And I think what we have today is a sort of generational indifference, which seems to reflect a degree of selfishness that I think will be remembered and reacted to by millennials for decades to come. Now, I'd like to explore this concept with Neil Howe, but how does one generation react to the generation or generations which preceded it? Every generation has its strengths. This is where we began our conversation.
Right.
Every generation has its weaknesses. And I would suggest that one of the greatest weaknesses of the demographic 50 to 70-year-olds today is a heightened focus on self-service rather than self-sacrifice. There are notable exceptions, absolutely notable exceptions to this, but the generation likes to focus on money. And I go back to the conversation I had with a gentleman on the plane. It took him 50 years to learn that there was more to life than money. And yet I think his generation pretty much would say no. I think there's a lot of things that you sacrifice, relationships included, for self-interest. And again, the kind of what's in it for me, how many more dollars can I accumulate before my game is over? Politics reflects the same level of self-interest. Politics has become a polite excuse for why nothing gets done by bureaucrats. And politics, if you wanted to use the word politics as a euphemism, it really is a euphemism for corruption. Because nothing ever gets done without interested parties being taken care of first. This may be Brazil, this may be China, and they're obviously trying to break down on this and crack down on corruption there. We haven't even begun to do this here in the United States. But the last thing I would add to the list of things that siphon off wealth from the economy is just that, corruption in the political process. This too diminishes the economy's ability to recirculate money through the economy. And it probably, in my opinion, gets worse before it gets better.
Well, lest we sound too dark, okay, there are independent decisions and individual decisions that you have encouraged our listeners to make, those who work with us to make, and that is, if you don't like the debt economy the way it's running, don't participate. Okay, put yourself on a gold standard, doggone it, and make sure that some of your assets are outside of a system that's so corrupt.
If you don't like the siphoning off of wealth from small businesses in your community, maybe you should order every other time you would normally order from Amazon. Maybe you should go down locally and buy a book from a local bookstore, or buy this or that from a local pet store, rather than buy everything
and
online.
Develop a relationship with people, and actually maybe spend a little bit extra to buy a book at a local bookstore. You know, there's one here in Durango, Dave. It's a great one. It's called Maria's. And Maria's bookstore, yeah, you're going to pay more than Amazon, but there are relationships there. I can walk in and they can tell you what books that they recommend. Okay, so is it worth the extra $3, $5, $7? Yeah, most of the time it is, if I just take the time to go down and continue that relationship.
Prioritize relationship. Now, you know, I think one of the things that rings in the back of my mind is a comment that Mark Faber made to us maybe 2 or 3 years ago. And we were having a conversation, and it was about as gloomy a conversation as you could have. And I asked him, I think, so what does this mean? I mean, is this kind of the end of everything? And he said, yeah, we're all doomed. I thought, okay, yeah. Well, but for me, the pivot point is discovered in a conversation with Neil Howe, where you say, no, it is always darkest before the dawn.
Right.
And when you look at this 600-year history of, again, cyclical change and cultural and political and social change, the evolution or the devolution that occurs every 100 years, the nice thing is that it happens about every 100 years. And we've got some idea of how the millennials will be reacting and what their disappointment looks like and what their priorities and what their values, how they take shape in reaction to the crisis that we're creating for them. The hope is not that we get to avoid financial crisis. The hope is that we have reasonable minds and that we have soft and tender hearts and that we have some awareness of a greater set of values and intangibles than have been cultivated in the current generation. And you look at that as it's applied in the economy, as it's applied in our households, our daily lives, in our small businesses, the way we operate, the way we respect contracts, the way we invest in relationships. I don't think it's hopeless. It's just the beginning. The reason why we focus and have for a long time on precious metals is because it is a currency which allows for wealth translation through difficulty. It allows you to basically take something and put it in a time capsule and say, tomorrow when I need it, I have it.
And it's not based on debt. It's based on reality.
And I don't necessarily know what tomorrow looks like. That will play itself out as it will play itself out. But what I have is something that for 5,000 years has enabled free action and free thought. And that's what I'm looking forward to, is you look at what Neil Howe describes as a first turning. which follows the fourth turning. It is the spring that follows the winter. It is the new life that comes after death. And what is it exactly? What resources do you need? What resources do you need? We explored this with Chris Martenson a number of years ago, and basically the resources are not just financial. Yes, we have an emphasis on tangible assets, but as I wrote the book, The Intentional Legacy, that really was the focus, was to say, hey, listen, in every generation, you have a choice to pull yourself up by your own bootstraps. It doesn't matter what you inherited from the previous generation. It's on your shoulders to set the trajectory from now and moving forward. And I think that's what we have on a broad scale, not just what you inherit, physical, tangible assets, or complete social and emotional emptiness and bankruptcy, because those kinds of things can be translated from one generation to the next. But the question is, what will you do with what you receive? What will you do with what you are receiving? You may not like it, and frankly, it's up to you to change it.
Thank you for listening to today's McAlvany Weekly Commentary. We'll see you next Wednesday. Be sure to follow us on Twitter at ICA Gold for our latest updates and market thoughts. And, of course, you can follow David at David McAlvany, McAlvany. And if you'd like to learn more about us, give us a call at 800-525-9556.
This has been the McAlvany Weekly Commentary. The views expressed should not be considered to be a solicitation or a recommendation for your investment portfolio. You should consult a professional financial advisor to assess your suitability for risk and investment. Join us again next week for a new edition of the McAlvany Weekly Commentary.